Hi, I'm Dennis Hudson at OrangeQuant.com, and I want to talk to you tonight about 3 dirty little secrets that come from automated trading programs, trading methods and books, and the trade alert services that you see around. Now this video will probably take about 10 minutes. I'm hoping to get in under 10 minutes. If not, there will be a second video to follow this. And just to be upfront about this, I do have an agenda, but I'm going to save that till the very last, the last couple minutes, and that's when I'll talk about what I want to talk about. Now first off, let's get rid of a common myth about why it's, you got to be careful with these systems. And the argument is, if their systems work so well, they wouldn't be selling it. Well, that's simply not the case. There's actually a very logical reason why people who have working systems would sell them to you. For one thing, it represents an extra profit center. So nobody's adverse to profit as long as it doesn't impact their bottom line of trading. In other words, they can go on and trade their system. You having the system really doesn't affect them, and here's why. Now let's say this is the market universe, okay, and this is the little speck of people that they've sold their trading system to. In fact, that little speck is actually a lot smaller than you see here. I just had to make it big enough so you could see it. And that represents, say, 1,000 or 10,000 sales of their particular trading system or whatever it is, or their book and method, whatever. The real picture looks more like this, with one of these itty-bitty specks here being probably way bigger than their share of market. So you see, it doesn't really affect them to sell the system that works, assuming it works, to you because, gosh, it's not going to impact the market that much. People won't, as a result, trade in the direction that you have decided to trade as well, or that they have decided to trade using the same system. Because the big concern would be if, assuming their system worked and that people followed it, then if that number of people could have an impact on the market, then it would draw the attention of, as you see, market makers, hedge funds, mutuals, other institutional funds, which constitute a space about the size of that big red dot, that Death Star you see there in the middle of the universe. And what they do is they see people trading the system, and they set up on that, and then they start to short it if it's a system for playing long, and that tricks everybody, and they know everybody's nervous, and so they jump out. They take all their money. But because the fraction of this universe that represents the trading system that these people have sold is so tiny, it does not draw the attention of mutual funds and other institutional traders. Okay, that takes care of the myth that if you have a working system, you wouldn't sell it. Okay, that's just not true. In other words, that is not one of the dirty little secrets about these trading systems and books. Now I'm going to save the biggest dirty little secret till last. I'm going to start with one of the other ones here. Dirty little secret number 1 is that these trading systems and books, by and large, don't work. The alert systems and all, they basically don't work. Well, that's kind of stating the obvious. You probably already knew that, but have you ever stopped to think about why they don't work? Let's just take a minute and talk about why they don't work. The reason is that most of the trading system, 99% of them, trading systems and the ones you read about in books and the automated trading systems, are based on quantitative analysis one way or the other, and it's either statistical or dynamic quant. Now stay with me here, because this is going to reveal to you why these systems don't work. In statistical quant, what I'd like you to do is imagine a strange tree. It produces lemons and oranges in a certain mixture most of the time. And you might think of the lemons as days when the market is going down or the stock is going down. The oranges as days when it's going up, or vice versa, whatever makes you happy. So in statistical quant, and I know about this stuff because I'm in the field. I mean, I do, I sell systems and I'm a quant. So what we do is we go back and we look back over a certain period and we say, well, how many lemons and how many oranges did we have in the given period? And let's say that the standard is you get 60% oranges and 40% lemons out of this tree most of the time. Then what we do is we look at the most recent period, a much narrower band, and we say to ourselves, well, we've had 20% of this and 10% of that. It's time for XYZ to happen. Now the problem with this approach, this statistical quant, is that in times of extreme volatility, it blows up. Let us suppose that a frost hits, and let us suppose that oranges are more vulnerable to frost than lemons. This is what would happen. Your statistical relationship between oranges and lemons would change dramatically. You'd have a lot less oranges than you had lemons because the oranges would all fall to the ground and rot. So again, in extreme volatility, statistical quant fails you, and that's one of the reasons a lot of these programs fail. Now, with dynamic quant, to a degree, you can cure a lot of these defects, and I prefer dynamic quant personally, but even dynamic quant has its flaws. And what dynamic quant does is it reads data on the fly, more or less. It does look back. A good one will look back a certain distance to, you might say, kind of pick up some of the statistical stuff. But it's pretty much doing it on the fly, and what you end up with in extreme volatility is a lot of false signals which are like this. You don't know which way this thing is going. It's going up and down, left and right, and you can't make it out. So you end up getting scared, jumping in or out of a play. So dynamic quant tends to fail as well. And here is dirty little secret number 2, the pump and dump, which is what you really find in a lot of alert services where they send you an email or something and say, okay, this one's about to move. Okay, well, guess what? They were front loading that. They bought some of it quietly earlier, and they're sending you this alert along with maybe 1,000 other people, and an illiquid stock tends to move when it has that kind of action. And now we come to my all-time favorite, dirty little secret number 3, is that these outfits that do these things don't forecast. The automated programs, the booksellers, that kind of thing, they don't make forecasts. You go out there and you look around, and if you find somebody that's forecasting and hitting it 70% of the time or better, you buy it. But I don't think you're going to find more than 1 or 2. They're rare as hen's teeth out there. And why don't they forecast? Well, I can tell you from experience, I've noticed when I miss a forecast, and we've got good records here, maybe 85, 87% accuracy, I have noticed that if I slip, guess what? My sales go through the tank. They drop immediately. And I don't recover until I'm hitting my stride again. So it's not in these guys' interest to make a forecast. You want to put them against the wall and say to them, hey, I'll buy your system if you can forecast just for the next 10 days. Give me 10 forecasts or 5 forecasts. And folks, if they hit 70% at least, you buy that program.